So here we go. There's this big new market prediction that's making waves out there again. Not overly optimistic. Goldman Sachs, they've joined the crew now, and they're saying that they are forecasting a lost decade, as they're calling it, for the stock market. They're warning that we might see years and years of, at best, very modest returns. So let's break down what Goldman's predictions are, the arguments behind them, and what it could mean for investors. So Goldman's is saying that the annual stock market returns will average just around 3% over the next decade or so. Now, on its face, that might now sound horrible, but considering we've just come out of this period, or we're in this period where stock markets have done amazingly well, I want you to just look at this chart here of the S&P 500. It shows annual returns. Now, investors, and especially younger investors, this is all they know. For investors who are used to these boom times, 3% seems like a pretty steep drop, and it is raising concerns about whether we're truly facing a lost decade in the markets. So if we look at what's fueling this rather bearish outlook here, well, Goldman, others like Bank of America, JP Morgan, they point to two key reasons. Number one is high valuations. The S&P 500's current cyclically adjusted price to earnings, so the CAPE ratio, is sitting at around 37 times earning, and that puts it now in the 97th percentile. That means the stocks are more expensive today than 97% of the time in the last century. And that's a level that often leads to pretty sluggish growth. Second market here is market concentration. And they point out that today's stock market is incredibly top heavy. There are a few massive companies that are carrying most of the growth. We haven't seen this level of concentration since back in the 30s, and that isn't exactly a reassuring setup for broad sustained gains. Now, the concern here, the biggest concern, is that after 15 years of climbing valuations, the market might be due for a lengthy reversion to more typical returns, especially as we're seeing global economic growth cooling and interest rates remaining uncertain. Now, you notice that I'm not saying we're going to have a crash here. I can't rule that out, but I'm talking about a reversion. So that's really important to keep in mind here. So this is where things get interesting. When we hear these predictions about this lost decade, this isn't new. It isn't a new invention, but they always haven't held up. An example here is if you've been in the markets long enough, you might remember historian Niall Ferguson. In 2009, right after the great financial crisis, he said, and I'll quote this, "There will be blood. Many will be looking at a lost decade." So that's what we're talking about here. But instead, of course, the economy rebounded. The S&P 500 gained an average of 16.6% a year following the next decade. It also is worth noting that if you had blindly acted on these pessimistic outlooks, it will have led you to miss out, obviously, on some very big gains here. These concerns, I believe that they are valid. They are reasons for caution right now. But like I say, this isn't the first time that they have been wrong. So what can we learn from history? Well, when we hear about this lost decade, and we're hearing it a lot these days, your mind might flash back to the 2000s. Some of us will remember that. That brought two major downturns. We had the dot-com crash early in the decade. Then we also had the great financial crisis. Now, over that period, the S&P 500, it did see negative returns. Here is the twist here, and this is the most important part of this video today. Yes, the S&P 500 struggled, but other markets, other asset classes performed quite well. And if we look at some examples, in the 2000s, the TSX was up around 39% during that time. Small caps were up around 24%. And look at the bond market, 86% total return during those years. Very, very commendable returns during these times, and especially at times now when we think the bond market is so unattractive to so many people. So even in what was technically a lost decade for U.S. stocks, if you had a diversified portfolio, diversified investors did find growth opportunities elsewhere. The good news story here is that even if history suggests that Goldman's forecast will pan out, you still have options to get through this period and profit if you have selective diversification. So what am I saying you should do to prepare for this if this prediction in fact holds true? Well, if a long stretch of these low stock returns is ahead, there are steps that you can take right now to adjust. Number one, you can diversify beyond U.S. stocks. That's pretty easy to do. If you look at other major markets, you look at international markets, emerging markets, they could offer returns that the U.S. stocks may not. Also, consider bonds, consider dividends. With these potential rate cuts that we see on the horizon right now, bonds are becoming more attractive. Also, dividend-paying stocks can provide more stable income, especially during these low growth periods. Number three, focus on value stocks here. So growth stocks, they've obviously had this very, very impressive run, but a lot of analysts now are suggesting that value may be offering more resilience in what we're going into a lower return environment. And also alternative assets, things like precious metals, they are showing some renewed strength right now, a lot of renewed strength actually, as investors are looking for more stability, more alternatives, and assets such as real estate, commodities. They could also add balance to a traditional stock-heavy portfolio. I'm not a big gold guy myself, but this is a time where maybe that would be a good addition to a portfolio. So some final thoughts here. Is it time to panic? Well, I say no, but there is a big but on this. I think it's never, ever a bad idea to be prepared for the slower growth. Shifting some focus towards diversification can certainly be a smart move right now. And ultimately, while a lost decade sounds pretty daunting, history does show that investors with those diversified portfolios tend to weather the storms better than those who are more heavily reliant on one type of asset or on one focused market. So I would like to hear from you. What do you think? Do you think we're heading into this lost decade, or is this just another blip on the radar? Let me know what your thoughts are in the comments. A lot of people are wondering now how the U.S. election results might impact their investments. And on this topic, I'm excited for an upcoming event. Professor Jeremy Siegel, he's one of the top financial minds out there. He will be joining Michael Kovacs, who is the president and CEO of Harvest ETFs, and they'll be breaking down the market outlook post-election. And I'm really looking forward to hearing their insights on how we can position our portfolios for what is next. This really is a presentation that you don't want to miss. I'll be logging in. You can join me by registering for the event. It's happening Thursday, November the 14th at 4 p.m. Eastern Standard Time. I will put a registration link in the description of this video. Well, there's some new data out from Stats Canada, and it shows that there is still this very dramatic gap between Canadian homeowners and renters, and this goes now across all age group. And this comes from the Survey of Financial Security 2023. So let's look at some of the numbers here. For those under 35, homeowners hold a median net worth of $457,100. That's more than 10 times the $44,000 median of renters. And this disparity only gets worse with age. The homeowners aged 55 to 64, they represent a net worth nearly 30 times greater than renters in the same bracket. An interesting takeaway from this report is that the data also shows the financial benefits of owning a home are now often outweighing even the advantages of employer-sponsored pensions. Last year, Canadian homeowners without a pension plan saw a median net worth of $914,000. That's far higher than the $359,000 median net worth for renters who do have employer pensions. Now, according to Paul Kershaw, he's from the think tank Generation Squeeze, he recognizes this is a big problem, and he says the numbers are stark, worrisome, and signal that we have a systemic problem that risks entangling younger Canadians in the culture addiction to rising home prices to fund wealth accumulation. The federal government has announced a number of plans designed to help home ownership, but in my opinion, it's probably too little too late. We have also recently heard the government's planning to put caps on immigration. Again, a move that theoretically will help ease housing pressures, but I'm skeptical to see whether that would be enough or no. The only thing that is crystal clear to me is that if you're a younger Canadian with limited resources, honestly, your dreams of one day owning a home might sadly be out of reach. Well, the Canadian Revenue Agency is just making headlines, and not in a good way. Imagine you're a Canadian taxpayer, you log onto your CRA account, file a few fake tax amendments, and suddenly you're being owed over $40 million in refunds. Believe it or not, the CRA did approve these payments without verifying the information. How did it happen? What does it mean for Canadian taxpayers? Well, I'm going to give you the short version here. There is a story of a taxpayer who filed false returns, claimed millions in refunds, and the CRA started paying them. And it wasn't until CIBC flagged this large deposit, thinking it was quite unusual, that the CRA even realized that they had been scammed. Now, from there, the agency discovered that millions more were either on their way out or had already been spent. An investigation by CBC's The Fifth Estate and Radio-Canada revealed the scheme so simple that it's actually shocking. Here's how it worked. Fraudsters would file a false T4A slip when they would claim deductions that they didn't pay. That would amend past returns, and that would rack up massive refunds. And the kicker here, even though the fraudsters got refunds reaching tens of millions, it looks like the CRA didn't even have a system in place to verify these kinds of claims. By the time they scrambled to freeze the remaining payments, the damage was already done. $4 million had already been spent or moved out. Even more concerning here is that it wasn't an isolated incident. After investigating, the CRA did find similar fake T4A scams by multiple fraudsters who were taking advantage of a major gap here in the system. If we look at the fallout here, the opposition parties, they're demanding an inquiry. Conservative MP Adam Chambers, he is calling on the revenue minister to involve the RCMP. I hope that's the case. He argues that taxpayer data and money need tighter protection. Yeah, pretty obvious to me. Meanwhile, over at the CRA, they've implemented a new policy where refunds over $50,000 will face additional scrutiny. The CRA, for its part, it says that they're cracking down on fraud with every enforcement action at their disposal. But as a Canadian, I'm sure our fellow Canadians, we want more than promises. I'm asking for a full account of what went wrong, how this loophole lasted so long, and whether the CRA has the tools even to prevent future scams. What do you think? Let me know in your thoughts below. This will be my last report for a couple of weeks. I'm going to take some time to relax. I will be back mid-November. Thanks as always for watching, for supporting our channel. I truly do appreciate that. We'll see you in a couple of weeks.